This is Annuity Straight Talk. Since 2008, your host, Brian Anderson, has helped clients nationwide navigate the complex market for annuities. With Brian's assistance, hundreds of clients have achieved a profitable and secure retirement. I would know, because Brian has answered many of my questions concerning annuities and retirement planning. So that you can benefit as well, let's get started. Here's Brian.
Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 29. My name is Brian Anderson. If you didn't know that, you must be new. I built the website, I wrote everything on it, and I've been doing it online for 13 years. Coming next week, actually, is, by the time you guys see this, I will have my 19th anniversary in the insurance and financial services business. As you can see, joining me this morning, Rambo doesn't want to be left out of the party. He likes some morning cuddles after his walk. And we're going to talk today about something that's going to follow up episode 28 really well, I think, because it's kind of it's a consistent theme, because consistent concern for a lot of people. Last week, I sent it out. I wrote a newsletter a couple weeks ago. Last week, the podcast came out, and it's all about how to beat the market with an annuity. It's just another way to look at how you can use an annuity in retirement. It's not to say this is what you should do. It's back tested and academically proven in a lot of ways. But again, just like I said, if you can just add little pieces and parts of beneficial strategic moves to your plan over time, then you'll increase your chances for success and getting everything you want out of it. So it is time for Rambo to get down, and hopefully he'll stop biting me. But so there were a lot of questions, a lot of interest in episode 28. And I guess, possibly I'll do a follow-up on that and just kind of address some of those things. Criticism, concerns about the time period I use. Again, I thought I explained it pretty well in the podcast, but again, it's the subject of an entire book, and I try to make it easily digestible. So this week, however, I want to talk about something that's kind of on the other side of things, and it's timing an annuity purchase. With the market being really high, a lot of people hesitate, well, I don't want to get into an index-linked product when the market's high, because if it drops. So I'm going to talk about that a little bit. And there's a newsletter that went out last weekend. As I'm recording this, I have not written the newsletter yet. I told everybody it's been kind of hard for me to. So I'm kind of flying by the seat of my pants, haven't written it, and I will, I'm just going to show you a couple of visual aids and talk about a few things that I think are important to consider if that is something you're trying to do. Now, for the past 5 years, probably, I have heard people say the exact same thing. Well, I'll wait for the market to correct, and then I'll buy the contract. Now, as we get higher and higher in market values, the threat of a downturn becomes more and more likely. We've had, it's February 4th today. So yesterday there was a disastrous day in the market. It was starting to climb back. I think the S&P is still down about 10%. It's up a little bit this morning. Anyhow, but when I heard people say this, I thought, okay, fine, that's all right. And what the result, however, was that, if they were saying it 2016, 2017, that's about when, I think it was 2015 or 16 when, the NASDAQ and the S&P, finally broke above their previous high from 2008. It took 6 years to get back, right? And so that they say it, so everybody was still real nervous about the market, and they saw, 2017 was a, 20% return or something like that. It was a really good year. And they looked at it and said, no way this can continue. Okay, well, we did get 2018 was down a little bit, 19, 20, 21, all up. We had, the big dip in 2020, obviously for reasons we all know too much about, don't need to talk about. But it roared back, and I think it was 2021 was a positive 27% year. So all I had to say, a lot of people in 2016, 17 who said, I'm going to wait to buy one till the market corrects, they never bought one and then they missed out on all those yields in both the market and potentially what an index linked annuity would do. So the question is, at what point is a correction enough? And that's really the one thing you can't answer is right now the S&P 500 is down 10%, right? But are you waiting for it to go 20%? Is it 30%? When are you going to know? I mean, nobody knows where the bottom is. I'm talking to people who believe the fundamentals suggest we could go even, another 5, 10, 15% lower right now. But it remains to be seen. We don't ever know where that low point is. So it's kind of a tricky proposition. It's the same thing as, well, if the market corrects and you think it's going to go back up, then why wouldn't you just wait for that correction and put your money in the stock market? Why are you using an annuity? Because the purpose of the annuity is to get gains if it goes up, but not lose if it goes down. So in a way, the annuity itself will help you time the market. But again, everybody wants to be as specific as possible, and I don't disagree. I mean, obviously, I try to outsmart the financial markets as well in certain ways, so I don't blame anybody else for wanting to do the same thing. But again, it's hard to find the bottom of that. And so, in the past 5 years, a lot of people never got into anything. And some people probably did go into the market eventually, or maybe they bought an annuity from somebody else and didn't tell me. But I do know several people who kind of sat in cash, too scared to get in. Maybe not with everything, but with a chunk of assets where they would have done really well to have an annuity that whole time. But instead, they sat in cash, 0.5%, 1%, super low right now. Going forward, we don't know what happens. So if you buy the index annuity, if the market, it seems like the last few years defied logic. Why is it going up? Businesses are failing, people are out of work. It's because there's been a ton of government spending that artificially propped up the market. So you can't be happy with your investment account balances and disappointed with excessive government spending at the same time, because everybody got their stimulus. I don't care whether you got the $1,200 COVID check or what, whether you have a bunch of money, you don't have any money, everybody got something. And the people with a lot of money got even more, because if you have a large 401k IRA balance, well, that propped up and boosted the market. Without that, we would have had a serious disaster financially. So it helped, but again, be grateful for it. That was a form of financial stimulus as well. And I don't know if everybody really thinks of it that way. So timing the annuity purchase is tricky. Now, there are a couple of things that are interesting about an annuity itself, and I think a lot of people don't understand the basics of how it works. And I think I'll probably do another podcast on some of the index options and explain exactly how they work. But there are a couple ways that you can mitigate it if you're worried about not having the right timing. A lot of time it takes a couple years for people to get into it and really relax and say, just let it work and it's doing fine. So again, most index annuities have a fixed rate account. Okay. If you think the market's going to dive in the next year, but we don't know when or by how much, you can put the money into the annuity and get a fixed rate account. Many of them are paying between 1.5% and 2% right now. And that is far better than what you're getting in the bank. That's far better than what you're getting in the money market fund. And it allows you to get into the annuity and have, a little bit of earnings in the first year, 1.5%, 2%. It's not the most exciting thing, but if you're sitting on 0.25% at a credit union or in a money market fund, well, that's pretty dang good then. And then you can, at anniversary, you can switch up and get the equity-based index and go up. So that's one of the quick ways to do it. And basically I should have explained from the beginning that, obviously, in the past few years, people that did buy annuities, to protect money, saw the market go up. And I've showed you several contracts that did really, really well. 10, 12, 15% was the highest I've seen. I've heard about others that were even higher. And it's a matter of timing, but because we don't know what's going to happen, that's what the annuity is supposed to do. So if it goes up, because where we're at right now with a 10% correction, and they didn't pass a stimulus bill a month ago or so. So that will, but it's not to say they won't come out with another one that's going to juice that up. And then, you might see the year finish with, a 10, 15% total yield, from the beginning. I don't know what's going to happen. Again, that's what the annuity removes the uncertainty. So what happens is in a contract, if you miss it the first year, you typically get it the next year. So if you buy into an equity-based index this year, and let's say a year from today, the market is 30% lower, big correction, okay? I don't think that it's impossible for that to happen, but again, I don't know. And I'm just trying to make sure everybody understands all of the ins and outs. But if it's 30% lower in a year, well, you get to start at that lower figure for the second year. So typically, I've seen a couple of contracts do 0, 1%, 2%, where the indexes didn't perform well or the timing wasn't right. In most cases, those will come back. And in the second year, third year, then you might see a big jump or a rebound where you get 10, 12%, maybe more. But, if you go 0 the first year and 12 the second, well, you're still averaging 6, which is well above, what our projections are. Not saying you couldn't do it. I know people that are 5 years into a contract, timing was perfect. They're averaging 6%. That can certainly happen. So again, the annuity removes the uncertainty. So the second thing is, so we talked about the fixed rate. The second thing is there are options that move inversely to the market. Okay, there's a lot of indexes that are based on bonds or treasury yields and simply track the movement in the treasuries and the percentage gain in the the bond markets or the treasury market. So if you get a lot of stock market volatility, you're going to get if you get a major correction, a lot of times people flood to U.S. Treasuries. That typically pushes the rates down, consumer rates down a little bit. And so that would create a positive yield in a bond-based index. Okay, so there are ways to capitalize. Now, it all comes down to picking correctly at the beginning. So that's where, again, the uncertainty. So the worst thing happens, you come at the end of the year and you're at 0. The other thing is there's a handful of contracts that have an inverse option on the S&P 500. And I'll tell you what that means is if you can bet on the market going, it's a put option, you can bet on the market going down. So if you buy the contract and you put all your money into the S&P inverse, then if the S&P is flat, so if it's 0% or negative by any amount, you'll get a positive interest credit. So they call it, most of them that I know of, that they don't have like participation rates on them. It's just called a declared rate performance trigger. So if it's negative, you get 4%, 5%, whatever it is. Really nice to be able to do that in times when the market's down, where maybe your other assets, if you got anything left in the market, is down in value and you get a 4 or 5% credit on the index annuity. So it doesn't matter for those ones. So let's say the performance declared rate is 4%. It doesn't matter if it's down 1 or down 30. If it's down or negative or down at all, you just get 4%. So there's an inverse trigger. So if you really believe the market's going down, don't know what to do, that's an option. But again, you're still taking the risk of, do you know that's exactly where it's going to be? Haven't had great luck with the inverse in the past few years, obviously, because the market kind of kept climbing. And then, but it's still out there, and there's going to be a point in time when it does hit. So if you choose that, then you'll do well, and you'll be happy when everybody else is kind of scratching their head. I lost some money. Okay, the third one, which I think is good. There's probably a lot of other ones. I mean, there's 450 some odd index annuities in the market, and you can break them down into categories, really. So it's not, in the end, it's not. I mean, I looked at one for somebody the other day, and it was an AIG contract, and it was a 5-year index annuity, and AIG had 6 different versions of the same contract. And it was all based on who sells it. So they had one for Chase Bank, one for Wells Fargo, one for an independent channel, one for another. I mean, there were 6 different of the, identical product. So that's what, you start looking at some of those things, you whittle them down. There's not as many as it seems, but there are probably a lot of interesting ideas out there as well. So, but one that I like that was in Great American contract, other contracts have similar type indexes, but it's called the Spdr gold shares. So you're tracking the price of gold, which didn't do that well last year. A couple years before, it did really well. But you could get a 5% cap rate on the gold market, and because the market was really high, people were rushing into risk assets, and that's where they got their biggest yield. Gold kind of settled. Now, I will tell you that I think gold and silver as precious metals are far below. I think they're intentionally suppressed in value, and I think they're far below what I think. There's a lot of value in those contracts, but that's a different subject about precious metals and owning them, and what, how that may or may not be a part of your plan. But as far as a gold index, if you've got that in an index annuity, that's something that certainly could perform positively when the market's down in value. So there are ways to grow even when the market drops. I've written a newsletter about it in the past that probably covered the basics of those three options that I just talked about. So the other thing people need to understand is, and I am going to share my screen. There it is. I'm going to look at a couple. Well, first and foremost, I'm going to look at the S&P 500, okay, for the past year. And I'm not sure you can see this all that well, but it's an attempt. So again, I typically look at Bloomberg, but for the S&P indexes, they've got really nice charts. And what we're seeing here is in the past year, this is as of February 3rd. Now, this is right after it dumped almost 2% yesterday. So you guys aren't going to see this till the 10th. It doesn't really matter because it's going to go up. I think we're going to see that up and down. Yesterday you got short selling. You had Facebook took a huge drop. I mean, wasn't that crazy? Set a record for market capitalization, wiped off the market. $252 billion in equity value disappeared from Facebook in one day. Crazy amounts of money out there. But so after that, it's 16.9% over the year. And I guess I'm having kind of some. Oh, okay. I'll accept cookies. That helps out. So, okay, that's a little bit better. Sorry about that. So this is kind of our benchmark. So this is where you're looking at. So right now you can get an index annuity with about 30% participation. You might on the S&P. You might see one at 35 or 40. It's probably a teaser. They're going to pull it back after that first year. But here's our benchmark. Now, this is the difference. People are looking for a drop in the S&P 500. Now, it is down about 10% or close to it. But that's only one of the minor options that's available in a contract. So let's look at another one that is available, okay? This is called the S&P 500 Risk Control 10%, okay? The S&P 500 let's go back there real quick, and from the top, it was at 47.93. It's down to 44.77. No. Okay, so it's probably down. It's down not quite 8-9% or something like that. You look at the daily risk control 10, and its top was here at 1253, and its low is here at 1203. So that represents about maybe a 4% drop. Okay, so you had the S&P 500 is down 9. This is down 4. And the reason is because there's a risk control mechanism in it. So this is purely based on the S&P 500, but when the volatility index is high, they shift a lot of those assets to cash. Now, if you watch Bloomberg or anything like that, on the right side of the page or of the screen will be, the Dow, the S&P, the NASDAQ, whatever else. And in the bottom, it'll say VIX, V-I-X. That's the Volatility Index. And its average last year, it averaged somewhere around 25%, I think. But in the past couple of weeks, when I look at it, it's been right around 30. So if the volatility in the market is 30 and you got a 10% risk control, it's likely they've only got 10% of those funds exposed to the S&P at any given time. What you can see in comparison to the S&P 500 is it's a much smoother yield curve, okay? So what you also will see is you'll have the S&P risk control 10 could indeed end up positive even if the S&P 500 is negative. Because they don't have the same exposure, volatility calms down, you get a slow climb back in, they're more equity focused, and then it goes up from there. So the idea behind this is to produce steadier returns and have a higher likelihood of a positive yield. Now, if you buy, so the insurance companies, and this is the subject of maybe an even different episode, if the insurance companies are buying an option on the S&P 500, that is heavily traded, and because of the volatility associated with it, the prices fluctuate wildly. So what you see in the contract is you see a variability in the participation rates or cap rates on the S&P 500 that you don't see in some of the risk-controlled contracts. This is how it was explained to me from an internal person at one of the insurance companies, is that with the risk-control contracts, they can have better assurance of long-term pricing with those index options, so you don't see as much variability in the overall contract. Or in the rates, because nobody likes to see, oh, my rates went down. So this one, so there's a great story, is so this one, S&P risk control 10, there's risk control 5, there's 8, I think somebody's even got a 12, which is going to lead to more volatility, but maybe higher yields. But somebody about 5 years ago said, I want the highest participation rate on the S&P 500. And I showed him this index, which had a higher participation rate than the S&P 500 from another contract he was looking at. And he was looking at it from a company that didn't, and they were starting him at a 50% participation rate on the S&P 500. Pretty good at the time. But it was 10, 15 basis points higher, or percentage points higher than, the average in the market. So I was skeptical about it. He came back the next year and said, well, they took him from 50 to 32. And then the next year, they took him from 32 to 18. Who knows where I want to say, even told me it was as low as 11% at one point in time. So because, of the volatility and the cost of the option, that rate came down, 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 down. That's why I say it's a teaser rate. All the contracts that I sold on this one have the same exact rate as they started with, because they have more consistent pricing projections with these indexes. Again, this is, I guess, off the topic, but the difference being that you've got a good index that can move, and this is not inverse to the market, but I'll show you one of those in just a second. But you need to understand that the indexes you're following don't necessarily mirror the market. They'll kind of shadow it a little bit, but it's not going to have the same correction in the index as you do in the market itself. So that's something you have to keep in mind. And when you say, well, I want the market to drop, but what you really need to look at is, if you're trying to time a low purchase point, you need to look at the indexes you're going to be using, okay? That's all there is to it. So next example. This is the S&P Multi-Asset Risk Control Index. Now, both of these two have, there are hundreds of indexes used. I could look at all of them. I just thought it was easy enough to pull the two S&P indexes, all right? So what you'll see here is, what did I have on this one? I had a 1 year on that one. So the multi-asset risk control, this can move inversely to the stock market, and I'm going to give you an example of that. Now, this is made up of 1/3 gold, 1/3 U.S. Treasuries, and 1/3 S&P 500. They're targeting a 5% volatility index. So if the VIX is 30, then 5% of that, be about a sixth of it, then they're going to shift only a sixth of the assets are going to be in the S&P 500. And it moves around all day. They actually have a really cool chart that shows 24 hours of the blending of the three assets, and it moves around all the time based on, it's algorithmically controlled through the index. all that stuff. I mean, it's very interesting. So because it has gold and because it has fixed interest, 2020 was an excellent example of this. But I remember in March 2020, that's when we got the 35% drop in the S&P and the Dow, just a nightmare scenario. Well, because interest rates dropped and gold shot up, the volatility was high, so the S&P exposure in this index was not that high. They got an increase in yield from the rates dropping and an increase in yield because gold shot up a lot. And that's part of the reason both, rates rose and gold settled as well. Part of the reason why you can see it's down 1% in the last year. But that index was, when the market was down 30, this was up 15%. 70-80% participation rate on that. And you could have had 10 to 12% yield when the market was in the toilet, right? And it's not even just the fact that you make money when everybody else loses money, but you didn't have, that had to be heart-wrenching for people to lose 30% after that whole run up and all that stuff. But so I had one client who had he had one contract with the inverse option and this option. He had 75% of it in the S&P Mark V. He had 25% of it, it was 80% in the S&P Mark V, and he had 20% in the inverse option. So for a time period, he was winning on both sides of the trade. It was amazing. And I was crossing my fingers. I think it was his contract, was set up in June, early June. And so I was watching it every day. And I look at everybody's stuff and I want to make sure I have a good handle on what everybody has. But I remember watching his specifically and thinking, man, he's going to win on both sides of this thing. And about a week before he reset, the S&P climbed back to go just above where he started the previous year. But very interesting. And again, so this isn't going to move as much. If you see the top to bottom of this one in the past year, the range is 368 to probably the top here, 389. And again, this one it's a great index. It can easily move inversely to the market because there's a lot of value in it, and there's a few different levers in the way they work. It has worked really well for people in the past. So, but it's only got about maybe a 5% difference between top and bottom. And so you're not going to see the volatility in this. And you could look at it, and even if everything's flat, there have been a lot of people that have come through, and just in the past few days before a reset, this thing will pop up 3-4%. You get a drop in rates, and then gold shoots through the roof. Bam. And all of a sudden, oh yeah, I still got 3 or 4%. So pretty good. That's another thing. Again, watch the index you're going to be tracking. Do not, just watch the market. You got to watch the market, but you got to pay attention to the index as well. So if you're trying to buy at a low point, that's the point being that these don't necessarily move exactly like the market does. And there are a lot of indexes available that move inversely to the market. So hopefully I kind of gave you something to think about. Because I just want everybody to, understand what it means. So you set your goals. I'm going to try to work with you and your goals the best I can. My objective is to help you get what you want. My objective is not to tell you what you need. And I hope everybody understands that, because I put a tremendous amount of information out there, and I got a lot of people trying to jump on and say, oh, hey, come work with us. Come do this, come do that. No, because I don't want anybody telling me what to do. And as long as I stay independent, then I can be the most realistic voice for you and give you the best information and the straightest scoop. And that's what Annuity Straight Talk is about. So I want to say thank you to everyone for joining me on this podcast. Check out the newsletter if you want to see it in written form. Let's see, if you want to get notified of the podcast, I've got a special guest coming back next week. Everybody's going to be excited. But I'll leave that. That's going to be a surprise. So another guest next week. And but if you want to subscribe to the podcast, go to youtube.com, search Annuity Straight Talk, hit the channel, hit subscribe. Go to your favorite podcast platform. This one, you could probably listen to it. There's not a whole lot of visual aid, but there's some in there, and that's what YouTube's good for. If you want to chat with me, you call 800-438-5121 or hit the schedule a call button, top right corner of any page on AnnuityStraightTalk.com. Anyway, thank you guys for joining me. I look forward to speaking with you next week with my special guest. And you guys enjoy, do your best, and I'm here if you need anything. Have a great day. Goodbye.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.